Hello Singapore and Asia Pacific. At S&B, we're excited to revisit Singapore and work with traders interested in learning the U.S. equities market. I'm Mike Bellafiore, author of the trading classic One Good Trade and partner at PhillipCapital, a proprietary trading firm that sits in downtown Manhattan. Ask me one-on-one questions about the markets. Learn the best trading setups from our experienced traders. Finally, take control of your trading decisions. Trading is the best job in the world. Please come and take our training class in Singapore and learn how the pros do it. I look forward to meeting you soon.
Welcome to PhillipCapital Weekly Market Watch. My name is Victor Y from Unit Trust Research. Today we are going to look at emerging markets as a whole and understand the underlying reasons behind the underperformance as compared to their developed counterparts. Brazil in particular weighs heavily on emerging markets index, is leading the slump. The widespread unrest in Brazil is sparked by a 7% increase in public transport fare. The fare hike jolted the anti-government sentiment at a critical period when the government is facing stagnating growth while an above-average inflation level. As of latest available data, Brazil's GDP expanded at a paltry 0.6% annualized in the first quarter, cooling from 0.9% recorded in 2012. Further, inflation spiked to 6.7% despite a slew of interest rate hikes. The current cost of travel in a crowded public bus in Brazil is equivalent to the cost of travel in Japan, while an average Brazilian earns a quarter of what an average Japanese earns. Economic boom of the past years gave rise to a burgeoning middle class. Brazil is a commodity-rich nation whose major trading partner is China. As the world's second-largest economy shows signs of fatigue, demand for Brazilian exports decreases. Thus, more people are put out of jobs and the main bulk of protesters are noted to be the middle class, who faces declining real wage and increasing food prices. Meanwhile, infrastructure expansion for the next summer's World Cup has grinded to a halt. While the argument is heavily tilted towards external factors such as anemic external demand and weaker commodity prices, Brazil is effectively a consumer-driven economy. Trade accounted for 11% of the GDP, while services accounted for more than 60% of its GDP. Hence, when the middle class is squeezed, Brazil is likely to go into contraction. In a bid to curb rising inflation, the Central Bank of Brazil has hiked benchmark interest rates several times, from 7.25% to 8.5%. Following suit with slowing domestic economy and rising inflation, India pursues similar monetary policy. India expanded at 5% in 2012, the slowest growth in a decade. As for China, shadow banking has alarmed the central bank to issue a stern warning to banks when the PBOC allowed the short-term overnight rate to float at a nosebleed interest rate as high as 30%. For many emerging market investors, expectations have to be revised downwards. Stellar growth rates will settle at a low gear for the foreseeable future, as many emerging economies implement structural reforms. External demand is likely to remain weak, even though there are evidences of a stronger than expected US recovery. From a top-down investment perspective, we are bearish on emerging markets as a whole, but remain constructive on China. China is a source of problem confronting Brazil and many other economies, but it does not have to grapple with inflation concern. Hence, the central bank has sufficient room to cut interest rate if the economy cools drastically. Secondly, China has not fully liberalized its economy. Thus, the external forces of fund flow will have limited impact to its economy. Third, the government has recognized the time bomb of shadow banking, but will take a series of steps to maneuver a smooth landing. Year to date, MSCI Emerging Markets Index has slumped close to 10%, while S&P 500 Index has rallied more than 20%. It is likely that we are still quite some way to the trough of the commodity cycle. Moreover, Brazil will have to find a solution to its increasingly agitated middle class. The final punch could be Brazil pulling out of the FIFA World Cup 2014. In conclusion, we see an upside potential in Chinese equities, but further downside to Brazil and emerging markets as a whole. Not to mention Turkey has its fair share of domestic unrest, and Indonesia rupiah dive further against the dollar, which could worsen the deficits Indonesia is facing. Thank you for watching this week's market commentary. We'll see you next week.